without further ado, I'm delighted to be joined by Evan Jankelowitz and Naeem Tilley, portfolio managers at Sesfikile Capital, to discuss the global property market and share some insights on the current investment landscape. Evan and Naeem, welcome and thank you for joining me today. Evan, please could you set the scene for South African investors in terms of the broader opportunity set for global property investing, essentially answering why invest in global property?
Well, obviously as a starting point, diversification, because global property is very much unlike local property, and so too as a separate asset class is very much unlike global equities or global bonds. So setting the scene, really, it gives you a world of opportunity. Obviously the bias is towards the USA, and they've just got so many more sectors than we have available to us here. Sectors that are very relevant and sectors that are not necessarily so cyclical or linked to the general economy or the global economy, such as healthcare, data centers, cell phone towers, and more underlying sectors that Naeem will touch on later as well. So you get that diversity not only by geography, but also by underlying sectors and themes.
Great, thanks, Evan. Naeem, which key themes or opportunities are currently offering the most value?
Okay, so Elliot, there's two important themes I'd like to talk to today, and the first one is data centers. And I think most of us will agree that the amount of data we all use, whether it's Netflix or WhatsApp or even our just daily usage of data, has increased. But more importantly, in the last few years, the emergence of AI has really taken the use of data centers on another level. If you look at the amount of capex that the large hyperscalers have announced over the last few years, so the likes of Alphabet or Google, Meta, Amazon, Microsoft, they are expected to spend this year alone $700 billion in capital expenditure and expanding the AI data centers throughout the year. That number is even expected to increase next year as they continue to spend in AI. So this is a leading theme. And at the same time, what's important is on the supply side of data centers, it is very difficult to actually put these data centers out, whether it's because of the limited amount of power. Remember, data centers are heavily dependent on power usage. So it's not easy to secure the power supply, or whether it's land availability. It is very difficult to roll out these data centers, and it has created a bit of a shortage of supply, fueling rental growth. So we're seeing strong demand come for data centers for at least the next few years. The other important theme I'd just like to touch on is the necessity-based real estate. And it is exactly that. It's real estate that benefits from the demand, really from people's needs. So in the US, which is the key market for us in this example, the demographic shift of baby boomers over the last few years has really made demand for senior housing in the healthcare sector quite strong. And the big driver here is that baby boomers are, as a percentage of the population, is the second largest set in terms of population size, but is expected to grow by 5% over the next few years. So that demand for senior housing and skilled nursing facilities will remain very strong. And similarly to data centers, the amount of supply for these units are quite short. Remember, during COVID, a lot of the senior housing facilities, the construction starts or the new buildings actually came to a halt because there was a lot of uncertainty around how much of what's the demand going to be for these units going forward. And so with the supply having come to a stop then, and now we're not seeing a lot of that supply come to the market, the senior housing or the healthcare sector is benefiting from it. Look, the supply side will respond, I think, in time, but for the next few years, we're looking for net property income growth of double digits, 15 to 20% in most cases, and that's why the stocks continue to do exceptionally well.
Thank you, Naeem. Maybe to expand on that, what is the one area where the market may be misunderstanding the opportunities or risks within the global property markets?
I can go first there. So in my opinion, I think the rise of AI and the benefit we saw on the data centers, the flip or the other side of the coin of that argument is what happens to demand for office space. So as yet, we haven't seen a massive impact on the office market, but I do think it's a risk that we are facing. Now, with AI, a lot of the administration type of jobs, the finance and legal, and some low-skilled jobs could and will be replaced over time, and hence demand for office space around these type of jobs will start to dry up. We are seeing some impact of it in PPO markets, like the likes of Poland and some other smaller markets. I think South Africa, and I know the question is around global, but I think South Africa is a little more immune to it in the short term. And I say that because our market, the labor force is generally quite cheap. Our office rentals are much cheaper. So a lot of these large global BPO companies continue to support our local market by relocating their services here, but it is a threat to both our local and offshore office markets.
From my side, I see greening as a huge opportunity. Naeem spoke about certain aspects where office may not be in play, not from a work from home perspective, but more so from the risk that AI will take many jobs. But I do see that supply as a whole will come under pressure because building these infrastructures, these big buildings is not so green as such. And I do believe that there'll be a lot less supply across the board going forward. And, as Mark Twain once said, buy land now, they're not making any more of it. Similarly, with the scarcity of some of these assets. So I do think that, once you've got an asset that yields, and at the moment, especially in the retail front, for me, I actually like retail. Why is that? I think it's been unloved. Coming through COVID, it was really beaten down. It has bounced back a bit. But I think what it proved is that it has to work together with the likes of online trading or online retailing, as well as the fact that people are social beings. They want to be seen, they want to see, they want to touch and feel. So they want to be together. So I do think that the scarcity, that will eventually arrive coming through in the retail space will be something that people misunderstand and that they take it for granted, as well as the fact that you can get some of these assets or some of these companies at quite attractive yields. So in the US, Simon Group just bought, so it was Macerich, just bought an asset. It's they call it the high single digits. And the amazing thing is that bond yields, even in these inflated levels, is around about 4.5%, and they bought an asset around about 9%. Now that's still a very attractive yield. So you still get a nice carry, you have the scarcity value, and I believe you'll get growth in the long term. So I think that the benefits of greening will come at the expense of new supply coming through. And I do think some of the key assets will see some upward movement in value.
I agree. Now, how do we see the current inflation outlook influencing the performance of global property over the next 12 to 24 months?
It's a great question, but obviously inflation these days, or let's call it the geopolitical state of the world, is very much in flux. So yes, we're currently living in an inflated inflation environment driven by energy prices, and it's really started out during the Ukrainian-Russian conflict, and it's really passed through into the crisis in the Strait of Hormuz. But the truth of the matter is inflation is negative from an opportunity cost in the short term. And why is that? Because high inflation leads to higher interest rates. And with the property companies not necessarily able to react on their actual, to call it rental levels they charge, you generally get higher rates as a higher opportunity cost eating into the price or the valuation of the property companies. So inflation is negative in the short term, but it is quite positive in the medium to long term. Call it moderate inflation. Why is that? Is because rentals are inflationary linked. So in time, if there's higher inflation, you'll get higher rentals or higher cash flows. So short term, you'll have some valuation pressures, but in the long term, it will actually be somewhat supportive to cash flows. But in the short term, and again, that's the benefit of looking at this global market, because you have certain sectors that actually react positively. Those with very short rental cycles, for example, hotels. Hotels, it's really a daily rate. So if inflation spikes, you have the ability to push your rentals in the short term. Whereas, call it healthcare, for example, if you have a long lease with a hospital, you can't really adjust that because inflation is increasing in the short term. But there are certain sectors, such as, call it hotels, that will benefit in the short term from inflation.
And lastly, a question to both of you. Why Sesfikile and why the Curate Flexible Property Fund?
I would love to say our skill set, but we believe that there are a lot of smart people out there, and we do our real utmost to keep up with them. But the truth of the matter is we have depth and breadth. We have the most depth with regards to years experience in the markets compared to anyone else in this country, and also globally as well. We really have a lot of depth in in this space. Call it on average in our investment team, there's probably the fund managers here about 20 years experience, global and local markets, as the PMs of this particular fund. And the breadth is that we have, call it 6 investment professionals just looking at property globally and locally as well. So we have that experience in the market. But I think the most credible driver here is that it's our business. The founders of the business are still very much here, as well as the fact that all the investment professionals are incentivized by earnings of the company. So we're here for the long term. We're not here to have a one-hit wonder. We're here, our name is everything, our brand is everything. And I think that our alignment to our performance is really what makes the biggest difference.
Right. The Curate Fund offers investors what we think is a nice blend of local and global property, taken away from investors the need to keep on monitoring the global and offshore and local exposure. We look at that exposure on a daily basis. We are nimble enough to change the fund if the conditions need. And I think our specialist approach to listed property allows us the skill set to identify those opportunities in the market. Evan touched on earlier how the global market offers specialization and is exposed mainly to developed markets, whereas in the local market is more of an emerging market feel. And those two, I think, complement each other quite nicely to create a listed property product suitable for different economic cycles.
Thank you, Evan and Naeem, for an engaging and insightful discussion. One of the key takeaways is that global property offers South African investors access to a diverse range of opportunities, with different sectors and regions behaving differently at various stages of the economic cycle. It is therefore important not to paint property with one broad brushstroke. A key advantage of the Curate Momentum Flexible Property Fund is its ability to invest across both local and global property markets. In fact, it is one of only a handful of South African funds that has this flexibility. This broader mandate allows investors to access attractive opportunities that are not readily available in the local market, such as data centers, while benefiting from diversification across sectors and geographies. The fund has consistently outperformed its blended local and global property benchmark, and it is well suited to clients seeking to incorporate specialist property into their portfolios.